Hi, welcome back to my channel. I am OT George. So in this video, we'll be talking about demand and supply trading for binary options. In this video, I want to break down how we can properly use demand and supply, how we can properly take advantage of demand and supply, how we can draw it, how we can identify this demand and supply zone so that when we're trading, it will be very easy. So stay tuned as I will break this down from the foundations, and I will take it up to a full-blown demand and supply strategy. So what are demand zones? These are price areas where buyers were previously strong. They are price area where price left this area aggressively. Yeah, price left this area aggressively, showing that there were more buying orders than sell orders. In other words, the buyers were more than the sellers. That was why the price was able to move aggressively out of those areas. And when price returned to this zone again, just because price left them more aggressively, it tends to go back up again. For example, we have something like this. We have price going up like this. We have price going up like this, right? We have price going up. So we are at the demand. This is a demand zone, right? And this is a demand zone, right? Why? Because here price left aggressively. Here price left aggressively. So when it comes back down, it is more likely because price left aggressively is going to go up. Now, what you should put in mind, what you should have in mind is to know that even though price came back here, the this aggressive movement here is crucial. That aggressive movement is crucial for it to be considered a demand zone, because if it's not leaving aggressively, you can't call this a demand zone. So the difference between this aggressive move out of this zone in this pullback is what really makes it a demand zone. We'll be learning more of that as we go forward. The next we have is also what we have next is a supply zone, and it is the same thing. A supply zone is a price area where the sellers were previously strong. So sellers was previously strong here. It goes up again here. Sellers were previously strong, so that when price comes here, because of these strong sellers that was here, it may work now as what? As a supply zone when price returns back. So that is the basics of demand and supply. But we won't stop there, we won't be stopping there. Let me show you what we can do with this knowledge, because when you understand this, you're going to find out that you will be able to make a strategy, and this is what we call demand and supply. Now, the market psychology behind demand and supply. All movement in the market is formed by what? Imbalances, right? When price when there are more buyers in the market, the price goes up, and when there are more sellers in the market, the price goes down. So how does buyers and sellers comes into the market? Through their beliefs. If the beliefs of the buyers are more than the belief of the sellers, then the price goes up, because it is only belief that moves the market, nothing more. The main thing that moves the market is not the money, is belief. When you believe in something, you use your money to back it up. So the belief of buyers and the belief of sellers create these imbalances in the market. So when you know the psychology behind demand and supply, you know that when price is moving up, when price is moving up to a particular direction, then you should know that, oh, the buyers are being believe more on this. When price is moving down to a particular direction, is because the sellers believe more on this. So if price is going up like this and it comes down and now it's going up, is because there is a belief at this point in the market that the price will go up more than it will come down. Likewise, in a downtrend, when the price is going down like this from this point, there is a belief that the price will go down, and that belief is being manifested on in your charts. That is where the psychology behind demand and supplies comes in. So when institution or banks place a large or huge order, it leaves footprints on the chart, and this is what creates supply or demand. Like I said, the institution, when they believe that yes, this price is low enough, when it's high enough, we are going to buy there. That is the psychology between demand and supply. Now, why do the price now, after leaving this same zone that they believe, why do they come back here? And you can see, because when price leaves this zone, for instance, a demand zone, when price leaves a demand zone, for instance, this zone, you find out that the reason when the institution, the big banks, when they make their order, for instance, they have 100, or okay, let's say 100 shares to buy, right? They want to distribute 100 shares. If they should buy 100 shares at once, what happens? It pushes the market up too fast. It pushes it up too fast. And remember, for you to buy, there should be sellers. They should be sellers. So what these people do, what the big banks do, what the professional traders understand is that, for instead of them selling 100 shares, they sell only 20, so that there will be retail traders or uninformed traders who will be at the other side of the market to sell 20 shares to them. So when they buy 20, they come back again, right? And then they buy 20 again. That's 40, they come back again, and then they buy 20 again. 60, they come back, they buy 20 again. 80, and now when they are done, they buy their last 100 shares from here. So this is how they distribute the shares. And it's the same thing when they sell. They don't just sell at once. They sell 20, they wait again to that same place, sell another 20 or maybe 60, it goes back again. They sell 10, it goes back again. That is just how they work. Because if they sell everything at once, the price goes back down with full speed. Nobody would want to take the other side of the market. And for them to profit, you have to take the other side of their trade. This is how it does. And this is why price comes back to this zone, because they cannot fill their order at once. They have to do it little by little. So if they bought heavily at a demand zone but couldn't finish buying, the price will eventually return to complete their order. And these returns create what? Predictable reaction. And this is how you get your ranging market, whereby you always buy at the support. After buying at the support, you sell at the resistance. This is how it works. So knowing the psychology behind this um, demand and supply, let's go further now into how to identify this demand and supply in our charts. Now, there are four patterns to this creation of the demand and supply zone. We have the rally, we have the base, and we have the rally. This is what we call the demand zone. So we have something like this: an uptrend, a rally, we have a base, and we have a rally, right? This is for uptrend. We have for downtrend a drop, a base, right, and a drop. This is how we do it. Rally, base, rally, then drop, base, drop. Then another one for supply is the rally. Sorry, is the rally, the base, and the drop. And we have the drop. Sorry, we have the drop here, the base, and the rally. This is what we have. I hope you understand. Let me do it again so that you will understand very well. So you see rally base rally. This rally base rally, it is like an uptrend. Yes, it happens in an uptrend. You have the rally, you have the base, you have the rally. For an uptrend, demand. This is what? Demand. This is a demand. Then you have the drop, you have the base, and you have the drop. And what is this? This is a supply in a downtrend. Now we still have demand and supply forming in ranging markets, right? That means this is for continuation. This is for continuation in both uptrend and downtrend respectively. The base drop base, sorry, the rally base drop and the drop base rally is a reversal, which is like in a ranging market for the uptrend and the downtrend. So we have, for ranging market, we have the rally, which is the up, the base, and the drop. Likewise, we still have the drop, the base, and the rally. These are the shapes that you get. Yes, these are the shapes that you get. And now these shapes, you can find them in your trading time frame. For instance, you have a 1 minute time frame. You can find these shapes there. So for instance, you know this is a ranging, this is a ranging, this is a trending market, and this is a trending market, right? Now, if you can find this in your time frame, there is another way. There are other ways with which you can find this same demand and supply zone. That means, and one of those ways is by going to the higher time frame. For instance, you are going to the 1 hour time frame, right? You're going to the 1 hour time frame. You see a candlestick like this. You see a candlestick like this. You see another candlestick like this. Let's say we have a downtrend like this. Now we are looking for the demand zone. If you have a downtrend like this in a higher time frame, you know, definitely you get to a point whereby the market will have to do something like a retracement. So you get something like this. Get something like this. A green candle like this, maybe a retracement candle. When you get this kind of candlestick, the downtrend now, like a retracement, the downtrend continues downward like this. It continues downward like this. This has given you a drop, right? A drop, base, drop in a higher time frame. So in a higher time frame, you really don't need a structure like this, drop, base, drop, because it will take so many candles, it will take so much time to form this in a higher time frame. But in your 1 minute, you can see this and use it. But in a higher time frame, it is difficult. I just need you to know the difference of these things, so you can pause it and study these things, because it is very crucial as we go forward. Now, when you have the drop base drop like this, it is the same thing for an uptrend, whereby you have a candlestick like this. You have a candlestick like going up like this. Excuse me. You have a candlestick going up like this. You have another one, an uptrend. Mind you, there will be wicks. Yeah, there will be wicks. You have something like this, and then you have a candlestick which is going to cause a retracement, and then you have something like this. Yeah, right, or maybe as small as this, and you have the continuation candlestick just like this. This is perfect. Okay, now, so this is it. And so what do we have now? We have the rally, the base, and the rally for an uptrend. So when you have this now, you've identified, you now identify this zone. There may be wicks as well, so let's not forget there may be wicks like this here. Yes, and there may be wicks in this side here too. So in case you see the wicks, you understand there may be wicks like say like this here. Okay, now you've identified the zone. When you identify the zone, what should be coming to your mind is how you should draw this zone. Yes, because you identify the zone, you should draw the zone now. But before you draw it, you need a criteria. You need some criterias after identifying the zone. You need some criteria that will make you believe, yes, this is um this is a zone I would want to use. Yes, this is a zone I would want to use. And one of those criterias are a strong move away from the zone. You need a strong move away. A strong move away. For instance, this candle here has formed a drop, the base. This candle should be strong. You know, at the beginning of the candle of this video, I told you about that. I told you about the strong move away from the zone. This candle should be strong. It shouldn't be like a weak candle, because if it's a weak candle, it is not yet a zone. It is not yet a zone. We need to see that strong move here. We need to see it, and then we need to see a clean base. What is a clean base? Like this one now, we need to see that the wick is here, everything is showing clearly. We don't want to see messy or choppy charts. We don't want to see that. And we need to see that this zone is forming freshly. It's not a case whereby there are so many zones at the left or at the left of your chart in a ranging market. No, it should be the first clean, it should be clean and neat like this. We also want to see the location, and this is where the trend matters. You know, I always use the EMAs, the Bollinger Band, most especially the EMAs. If you are familiar with how we trade, you should know that in a case like this, you need the 200, the 100, the 50, and the 20 EMA or above this kind of setup. And in this one, you need the 100, the 200, sorry, the 200, the 150, and the 20, all below this kind of setup in an uptrend and in a downtrend. Now, when you get this, you are now putting the odds in your favor, because now this zone is becoming stronger and stronger because of these things you have identified. Mind you, without these things, the zone is still a zone. Without the strong move, it's still a zone. Without the clean base, it's still a zone. But is it a strong zone? This is where the question comes in. If it is it a strong zone? No. So you need these things like the strong move away, the clean base, the first zone, the location, and the clarity. It should just be obvious that yes, this is a zone. So let's move on so that I explain this better for you. So when you get that, like for instance, look at it here, the strong move away. So big candles should leave the zone, showing the true imbalance. The clean base, that small candle or consolidation before the original move, right? Because that's the start, the origin. The fresh zone, a zone that price has not touched before. Now the zone aligns with the stronger trend, and the move away should be obvious. This move away here, it should be obvious, like I just explained earlier on. So when you have this, you know that yes, this zone is now a strong zone, and then you move forward to drawing the demand zone, which is very important. Now, when to draw the demand zone, this is the same question when people ask, how do you draw your support and resistance? Technically, support and resistance is like the demand and the supply. So let's get on how we draw our demand and our supply zone. We'll be using these examples here. Let's see how we draw demand and how we draw the supply zone. So let's see this. So looking at this example here, okay, looking at this example, it says identify identify the base for a demand. So let's get it done so that we understand this once and for all. Sorry, my voice is bad now. All right. So let's do this. Identify the base candle. So how do you identify the base? You have an uptrend like this. Remember that there are wicks. You have an uptrend like this. And then you have a retest, which is you have the rally, you have the base, right? You have the base. The base may be one candle, it may be two candle. It does not matter. Yes, it does not matter. In short, I'm going to use two candles so that when we talk about base, you know what we are talking about, right? Talk about base, you know what we are talking about. Now, I identify the base candle. You see candle or candles where price post before moving up strongly. This is the base candle we are talking about. Now, you draw a rectangle covering the candle body and wick. Now, which candle body and wick are we talking about here? Yeah, which candle's body and wick are we talking about here? We're talking about this one here. So if we have 5 candles, we're talking about always the last candle here. So for instance, there is this candle and we have the wick like this. We have this wick here. Let's say this, okay? We have this wick here, right? That was what this instruction has said. Now, when you have something like this, you you don't know this is the last candle until the next big green comes, right? So you need to see the next big green. So we see something like this. We don't want a candlestick like this. Oh, sorry. We don't want a green candlestick like this. No, this is not what we are looking for. No. What we need is a candlestick like this. A candlestick like this, sorry. A candlestick like this. Candlestick like this. And then the follow up. You have the follow up like this, right? So you've identified the zone now, just like I said. Now to draw it, you now do what? Extend. You take your horizontal line, and then you take this wick here. You see this wick? You drag it here. You see this wick here, this body here? You drag it here. Now this is your demand zone. Now if there is a wick here, you can put this one at the wick. You can put it here. But I will get to that. I will get to that when we talk about this, the conservative trades and the aggressive trades using this. Now, this is just how you draw your demand zone. Now, let's go to supply zone. For supply zone, it is the same thing, but just the opposite. You have this, excuse me, you have this, you have this. In a downtrend, you have this. Now you have the opposite candlestick, which is the green candlestick. You have this. Oh, sorry. You have this. You have this, right? And you have, okay, let's leave this one like this. And at the top, you have the wick, or let's say at the bottom, you have the wick like this. So the demand zone is forming. You already know now. Why do you know that the demand zone is forming? Remember, this is a major downtrend. You've already seen the EMA's alignment and the price below it. So you can't confuse this to be an uptrend. You At this point, patience is now needed. These are the psychological skill that you need for your own setup to form. So when you get something like this, what you do next is to wait for the big move away, like we discussed earlier. So you wait for your big move away and it comes. You have something like this. Oh, why am I making this mistake? You have something like this. The big move away. That means this candlestick is just bigger than this one. And then you get this. Now you've seen the big move away. This can even be small like this, but it should be a move away. Now when you get this, you draw your zone. How do you draw it? Like this and like this. Or looking at this conservative way, you can also draw it. For instance, you want to draw, you have this, and you have this. So let's do this once for both sides. You have this, and you have the wicks. You have this wick, and you have this wick, and then you have the continuation candle like this. Now, when you have this, how do you draw? You take this one here. This is the conservative. You take this and you take this. This is the zone. Why are you doing this? Because you know price will come inside. Oh, sorry. You know price is going to get inside. When price comes back from here, maybe it goes down again, it comes inside. This is where you look for your confirmation. We'll be talking about that. This is where you look for confirmation. Now, apart from this, you can also do it the other way around. You can use the aggressive way, and that involves you using just the body. Yeah, you can use something like this and like this. So when you tell me how do you draw your zones or your supply and demand based on this candlesticks pattern, it doesn't matter what you draw. It matters what you've experienced when you draw it. You can do it like this because in this place you have price can react from here, it can also react from here. But personally, if you would want me to advise, I will say you just go using the wicks. Be conservative. You use here alone and here. You do the same thing for an uptrend and a downtrend. Now, when price comes inside here, then you know you can act, and that is what we'll be going on to next. So I've taught you how you can draw the wicks, how you can use the wicks to draw the zone properly. Now, after this, now we'll be going on to how seeing how price reacts when it comes to these zones. We'll be seeing how price reacts when they come to this zone, because definitely price will come here and get inside. There are ways we know that this zone is functioning because of a unique way in which price reacts when they come back to this zone, and that is what we'll be going on to next. And how is that? Rejection. We see three ways price react is the rejection. So let's go back to draw what we just cancelled, the rejection. And how is the rejection like? For instance, you have your zone here already. This is your zone for a downtrend. This is your zone for a downtrend. So what kind of reaction price usually gives after the market comes down. The market comes down like this. Now the market is going back into the zone, right? What you normally see, you see a candlestick like this. I would say you see a candlestick like this, yes, like this, and you see rejections like this from that zone. You know, this zone is what you drew from what we previously saw. You see a rejection like this from here. Now, you also get, let me extend the zone now. This is the first thing you get. The rejection can also come not only from here, you can also get the rejection from here as well. You can get the rejection from here as well. From here as well. This is what you can get. Or you get the rejection from here as well. inside with that, this is when the zone has been formed. You get rejection, then you know you are seeing a complete zone. Then the next thing you do is the break and retest, but I will talk about this lastly. Let's go to the liquidity sweep. So liquidity sweep means when the market comes down and it's going up, we know the price is going to reverse from here, but what we do not know is when, because we need to see evidence, just like the rejection. But what the big banks does is, even though they know the price should reverse from here, they want to get more people committed in the trade. Now remember that for amateur traders, we amateur traders will not sell here. They rather buy here because they are not going to look at the bigger picture. They are looking only at this move, so they will buy, right? So when the traders see that amateurs are buying, they let them buy on up until the price goes here. When the price comes here, now they see a breakout from this zone and they think, oh, the market will be going up. That's what they believe. They think the market will be going up, and then they bring the market back down. They took liquidity away from this place, so the market comes back down, trapping these traders, and then price continue going down. This is what the big banks and the professional does. They manipulate our emotions. They just need you to think in a certain way, and they make you believe it is true. So you see, like what it says here, price briefly moved through the zone, trapping traders, then it returns in the opposite direction. So the bank used this to grab stop losses. Like for instance, in the forex market, when people see that the price is going to go down like this, they put their stop loss here. So the bank deliberately go there to touch the stop loss and they get out. And so when they get out of the market, the price goes to their initial direction, right? So that's how it works. And then we have the break and the retest. This is what I also tell you about changing polarity. So when this market comes down and it's going up, there are times whereby it comes way down way too much and it experiences what we call a reversal in trend here. It experiences a genuine reversal in trend. So now the trend has already changed, but it has created a demand zone. The trend changed, but it created a demand zone. So, for instance, there is a creation of a demand zone, there is a two deviation Bollinger Band. Now, the trend changed. We are not expecting, since the trend has changed, the trend is stronger than any zone, it's stronger than any support and resistance. So, the pressure from the trend, we push this, we make this market go further up like this. You may see some kind of reversal, but it will not work. It will break this zone. It will come back to this zone now and use this support zone as what a demand zone for price to continue going up. It automatically changes, price continues going up. So you understand that the way price acts within this zone, there are of three types: the rejection, the break and retest, and the liquidity sweep. Now, when you draw your zone, these are what you should be looking for. Is this going to give me a rejection? Is this going to give me a break and retest because there is a reversal in the trend? Or is this going to give me a fake breakout? These are the three things that you should be looking at. Now, when you've gotten these three things, with experience and time in practicing this, you will know which one of them is coming out. These are the three scenarios that happens. It may just give you a rejection, it may give you a breakout and retest, and it will give you a liquidity sweep. Now, like I said in the beginning, there are time frames where you see this and you trade. For instance, this in the 1 minute, in the 1 hour time frame. When you get the 1 hour time frame like this, excuse me. Okay, when you get the 1 hour time frame like this, the best time frame, the 1 hour, the 30 minutes, the 2 hours, 4 hours, these zones are really strong. In other words, when you can draw your time frame, your demand and supply from this time frame, you see that when price goes there, this theory situation I just explained, they become really obvious. They become really obvious. Why? Because you are taking it from a higher time frame. Yes. So you use your higher time frame to find these zones. Then you come back down to your lower time frame to enter the trade, because when you draw your zones in the higher time frame, if you come back down to the lower time frame, you are going to see those same zones in your chart. Then you draw, then you take your trades. So like for 1 hour time frame, you use 5 minute expiration to trade. Like for 30 minutes, you use 3 minutes expiration, depending on what works for you. So you need to match the expiry with the time frame. That's how it is. Lower time frame zone like the 15 minutes, you can use 3 to 5 minutes. In higher time frame like the 2 hours and above, you can use 5 to 15 minutes. Then you see that the price will go down in that direction for that period in time. That's how it works. So after that, we now move to the binary option setup. Yes, the binary option setup. So I told you, you get a you identify a trend. Let's walk through this practical with an example. Um, okay.